Hey everyone, welcome back to the channel. So let's talk about something that stops a lot of people dead in their tracks: investing. Because if you've ever opened up a brokerage account, looked at all the options, and immediately closed the tab, you're not alone. It's overwhelming. And in 2026, with AI reshaping entire industries, markets moving fast, and everyone having a different opinion about what to do with your money, it's even more confusing than ever. But here's the truth. The investors who build real wealth aren't the ones who had perfect timing or some secret strategy. They're the ones who asked the right questions early, built good habits, and stayed consistent. So today, I'm going to walk you through the 10 essential questions every new investor needs to ask before putting a single dollar into the market. Let's get into it. Question 1. Why should I even invest? I know that sounds basic, but hear me out. A lot of people, especially younger people, don't feel urgency around this. Retirement feels like it's a lifetime away. But the math here is brutal if you ignore it. If you start investing $275 a month at age 25, with an average 7% annual return, you hit $1 million by age 70. If you wait until 30 to start, just 5 years later, you need to invest $361 a month to hit that same goal. That's 86 extra dollars every single month and over $41,000 more out of your own pocket just because you waited 5 years. Investing isn't just about retirement either. It's about buying a house, funding a business, having options in life. The sooner you start, the more options you have. Question 2. What does waiting actually cost me? Let's make this even more concrete. If you invest $200 a month starting at 25, you end up with about $733,000 by age 70. Start at 30, you end up with $512,000. That 5-year gap just cost you over $220,000, and you only invested $12,000 less total. That's the power of compound growth, and it works both for you and against you depending on when you start. The most common reasons people delay: waiting for a raise, wanting to pay off debt first, feeling like they need to learn more. Most of those reasons are actually excuses that compound into massive lost wealth. Start small. Start now. Optimize later. Question 3. How much should I invest? The good news is you don't need a lot to start. The most important thing is building the habit. A common framework is the 50-30-20 rule. 50% of your take-home pay goes to needs, 30 to wants, and 20 to savings and investments. For retirement specifically, experts generally recommend working toward 15% of your gross income over time. But if that feels impossible right now, start with 1 to 3% and increase it by 1% every year. You will barely notice the difference, and the results over time are significant. Even $50 to $100 a month into a broad index fund is a real start. Don't let the perfect be the enemy of getting started. Question 4. Should I use a 401k or an IRA? Short answer: ideally both, in the right order. First, if your employer offers a 401k match, that is your number one priority. A 50% match is an instant 50% return on your money. Nothing else in investing comes close to that. Contribute at least enough to get the full match before doing anything else. After that, open a Roth IRA if your income qualifies. The Roth is incredible for younger investors because your money grows completely tax-free. You pay taxes now, and every dollar you pull out in retirement, including all the growth, is yours to keep. Once your Roth IRA is maxed out, go back and increase your 401k contributions from there. Question 5. What should I actually invest in? If you are brand new, the single best answer is a target date fund or a simple 3-fund portfolio made up of broad index funds. That's it. A target date fund automatically diversifies your money across stocks, bonds, and international markets and adjusts the mix as you get closer to retirement. You pick the fund closest to your retirement year and you're done. It's genuinely that simple. If you want a little more control, a 3-fund portfolio works great. A total U.S. stock market index fund, an international index fund, and a bond index fund. Keep the fees low, keep it diversified, and don't overcomplicate it. Individual stocks, crypto, hot sectors, those are things you explore later with a small portion of your portfolio after the foundation is built. Question 6. What returns should I realistically expect? Here's where a lot of new investors get into trouble. They see a year where the market is up 20% and think that's normal. Or they see a crash and think it's all over. The historical long-term average return of the stock market is around 7 to 10% per year before inflation. After inflation, you're looking at 6 to 8% over long periods. That's the realistic baseline. And yes, there will be years where the market drops 30 or 40%. That has happened before and it will happen again. But here's what's also true. Over every 15-year period in modern market history, investors came out positive, every single one. Time in the market beats timing the market. Question 7. How do I handle market volatility without panicking? This is honestly where most people fail, not because they picked bad investments, but because they sold them at the worst possible moment. The two best tools against panic are dollar cost averaging and an emergency fund. Dollar cost averaging just means you invest the same amount every month no matter what the market is doing. When prices drop, your money automatically buys more shares. When prices are high, you buy fewer. Over time, this smooths everything out. And your emergency fund, 3 to 6 months of expenses in a high-yield savings account, is what prevents you from being forced to sell your investments when life throws something unexpected at you. Those two things alone will save most investors from their worst instincts. Question 8. Should I buy individual stocks or just stick to funds? For beginners, funds. Full stop. With a single index fund, you can own tiny pieces of hundreds or even thousands of companies at once. Your risk is spread out and your costs are low. Some index funds charge less than 0.1% in annual fees. That matters enormously over decades. Individual stocks can be exciting and some people do well with them, but they require real research, real emotional discipline, and a real understanding of the business you're buying into. A smart approach is to build your foundation with index funds first, maybe 80 to 90% of your portfolio, and use a small portion to experiment with individual stocks as you learn. Question 9. What about taxes? This one is underrated and it can make a massive difference in your long-term results. Prioritize tax-advantaged accounts in this order. First, your 401k up to the employer match. Second, a Roth IRA if you're eligible. Third, go back and max out your 401k. And if you have a high deductible health plan, a health savings account is one of the most powerful tax tools most people never use. It's tax-free going in, tax-free growing, and tax-free coming out for medical expenses. Most younger investors earning under about $95,000 a year are better off in Roth accounts because they're in a lower tax bracket now than they'll likely be later. Pay the taxes now. Let the money grow forever tax-free. And question 10, how do I actually stay consistent and not blow this up? Automate everything. Seriously. Set up automatic contributions to your 401k through payroll. Set up automatic monthly transfers to your IRA. Remove the decision from the equation so your habits do the work even when your motivation is low. Increase your contribution percentage by 1% every year. When you get a raise, send half of it straight to your investments before you get used to spending it. When you get a tax refund or a bonus, invest a meaningful portion of it. The biggest mistakes new investors make are waiting too long to start, panic selling during downturns, chasing last year's best performing investments, and switching strategies every time the market does something scary. Build a simple plan, automate it, leave it alone. All right, so to wrap up, investing is not about being the smartest person in the room or timing the market perfectly. It's about starting early, staying consistent, keeping costs low, and not making emotional decisions when things get uncomfortable. If you take nothing else from this video, take this. The best investment you can make right now is just starting. Even small, even imperfect, because time is the one thing you can never get back. If this video helped you out, drop a like and subscribe. I put out videos on personal finance and building wealth every week. And let me know in the comments, which of these questions was the one you needed answered most? I'll see you in the next one.